This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
They will also see Congress reach a historic bipartisan agreement to reopen the government and avert a default on the nation's bills.
It's my hope that today we can put some of those most urgent issues behind us.
Striking a deal, an 11th hour agreement to reopen the government and avoid default sends stocks soaring. But will this temporary fix prevent the markets from moving forward and hold back American businesses from making important decisions?
Leaving a mark, some of the nation's biggest companies have already been battered and bruised by Washington. What are their executives saying about the damage that's already been done to the economy?
And singing the blues, IBM, the bluest of the blue chips, posting a big revenue miss late today, sending shares sharply lower after hours. That could impact trading tomorrow. We have all that and more tonight on Nightly Business Report for Wednesday, October 16th.
Good evening, everyone, and welcome. An end is in sight, barring some last-minute snag no one expects. After days of frantic bargaining and multiple false starts and stops, a deal has been reached to reopen the federal government and avoid default on its debts. The agreement struck by Senate leaders Reid and McConnell is a temporary one, a truce more than an armistice, but it does meet two goals the White House insisted upon: get government employees back to work and authorize more federal borrowing without onerous conditions. Now, the bill needs to pass in both the Senate and the House tonight and reach the president's desk by midnight Eastern time. That way, it beats the Treasury's stated deadline when it says it could start running out of cash fast. John Harwood joins us now from Washington with more on the deal reached today, a timeline of tonight's voting, and whether we have to go through all this all over again in just a couple of months' time. John?
Tyler, you know that congressional manufacturing process is built around just-in-time delivery, and that's what we're getting tonight. We expect that the Senate is going to pass this bipartisan deal between Harry Reid, the Democratic leader, Mitch McConnell, the Republican leader, around 7:15 p.m. Eastern time. It would reopen the government through January 15th. It would raise the debt limit through around February the 7th. Meantime, Congress would negotiate a longer-term budget deal that would alleviate part of the budget sequester, at least that's the goal, and replace some of those sequester cuts with longer-term cuts in entitlement programs, which both parties have agreed need some reining in. That deal, which we expect to get more than 80 votes in the Senate, would then go to the House of Representatives. Speaker Boehner, after meeting with his members this afternoon, said that blocking the Senate bill will not be a tactic for us. So Republican opposition has essentially collapsed. That doesn't mean a lot of Republicans won't vote against it. But this is going to become law, be signed by the president, and it represents an alleviation of this threat of default that's been hanging over us for several weeks.
And so, John, and then we're going to go through all of this again in January and February. Do you think Washington lawmakers have learned anything from this, or is that a dumb question?
It's not a dumb question at all. In fact, it's the key question coming out of this, Susie. The president's goal in striking the line that he took, which is I'm not going to negotiate for Congress doing its job on reopening the government and raising the debt limit, was he's trying to break the habit of Congress getting into crisis mode and doing last-minute haggling that he considered unreasonable. So if he's right, if the president's calculation was right, we won't have as much drama in January and February. But we don't know that. Some of his advisors aren't so sure that he broke the habit. But we're going to wait and see whether Republicans take a different tack next time around.
All right. Thanks a lot, John. John Harwood reporting from Washington. Turning now to Wall Street, stocks rallied on word of a deal in Congress that would avoid a devastating U.S. default. Relieved investors bought up stocks, sending all the major indexes soaring, each rising more than 1%. The Dow surged 205 points. The Nasdaq jumped 45, closing at its highest level since the year 2000. And the S&P added 23 points. It's just a few points away from a new record high.
So with a budget deal looking like it'll pass tonight and hundreds of thousands of furloughed federal workers preparing to go back to work, just how much has the 16-day partial government shutdown cost the economy? A lot. The ratings agency Standard & Poor's now says the 16-day shutdown has shaved at least 0.6% off the nation's GDP, which adds up to a staggering loss of $24 billion ripped right out of the economy. And if that Senate bill doesn't become law tonight and the country defaults on its debt, S&P says the economy would take an almost immediate 4% hit, sending the U.S. into another recession.
Here's another negative from the shutdown and debt ceiling crisis: the money taken out of long-term stock and bond mutual funds. According to the Investment Company Institute, outflows from U.S. stock and bond mutual funds added up to around $5.5 billion just last week. For the week ending October 9th, domestic equity funds had outflows of more than $5 billion, while foreign equity funds added $2 billion. And municipal bond funds saw $1 billion move out.
So, a climactic day in Washington and for Wall Street. The question now, what's next for the markets, the economy, and your money? Here with answers, Mohamed El-Erian, CEO and co-chief investment officer of PIMCO, the world's largest bond fund manager, and Richard Madigan, chief investment officer with J.P. Morgan Private Bank, two of my favorite folks on Wall Street. Welcome to you both. Mohamed, let me begin with you, but I want to start by running a little soundbite from earlier today from your friend and rival, Larry Fink of BlackRock, where he expresses his sadness over what he saw this country just go through.
I would say there's a profound sadness. They looked at the United States as a beacon of hope. They looked at the United States as a great place to have a secured investment. And now they're raising questions, are those foundational principles correct going forward? And that's what I'm frightened of. The answer is I don't see any overt change in behavior yet, but I'm being asked questions related to this, and it may lead to changes in behavior.
Mohamed, what do you think there? He's referring to our standing in the world as a safe investment haven, our Treasury securities most especially. How do you react to what you just heard?
So we're all being asked these questions. The rest of the world is looking at us, Thailand, saying, what are you up to? How can you be so irresponsible if you are the issuer of the reserve currency and if we have delegated to you our financial intermediation? After all, we save by holding your bonds. So the rest of the world is confused, is taken aback. Now, you cannot replace something with nothing. So it's not as if they can go elsewhere in the short run. But it's not a good idea to do this, because at some point they're going to build pipes around the U.S., and that would harm our economic interests and our national security.
Richard, let me, and Mohamed too, let me bring up some comments that came from the National Retail Federation today. And this is a quote saying, our economic recovery is retail-led and consumer-driven. And political leaders on both ends of Pennsylvania Avenue need to stop undermining consumer confidence with partisan posturing. When consumers cut back their spending, it threatens jobs in every industry. So let me ask you, Richard, and Mohamed, feel free to jump in on this, is that to what extent has this episode, what has it done to consumer confidence? And what is it going to take, how long is it going to take for American businesses and the economy to bounce back from all of this?
Susie, from my perspective, I think the critical issue to this was what Washington accomplished was diminishing politics out and fundamentals back in. So if this goes on longer, I think it becomes something of real meaningful consequence. Beige Book today, and that was data through October 7th, continues to show resilient consumption, retail still in place, and growth. And S&P's numbers that Tyler talked about in terms of cutting back growth by 60 basis points, I would probably argue they were overreaching a little bit in their expectations. We still have a view that we'll see 2% growth this year. So confidence matters, but I think what the government accomplishes is getting people back to the fundamentals. And from where we are in markets right now, you'll recognize we've literally reset to where we were September 18th, right after the FOMC meeting. That's good news.
Mohamed, markets, broadly speaking, bond markets and the stock market, maybe more especially, didn't seem to freak out, didn't seem to overreact to what we've just gone through and hopefully what will come to a conclusion this evening. But how should I, as an individual investor, position my money with the level of uncertainty that seems to be lingering even tonight as we look ahead to another set of deadlines 2 and 3 months down the road? How should I invest?
So there were two assumptions that were key to the market feeling relatively calm about this. One is we would not default, and that was correct. The other one was this notion that you could look through the economic damage. Why? because people who weren't being paid were going to be paid. So the damage would be temporary and reversible. This second assumption is more questionable today, because what we got is not a resolution. You called it a truce. I would call it a ceasefire. We simply got a ceasefire for a few months. And if there's one thing you don't want to do, is play Russian roulette with consumer confidence ahead of the holiday season. That's not a great time to do it. So our concern is that the bounce back will be less dynamic than it would have been otherwise, because people know that there's a risk that we may go through all this again in January and February.
Mohammed, the other thing that's up in the air is the U.S.'s credit rating. Does the U.S. deserve this sterling AAA rating, given that we are going crisis to crisis? And if there is a downgrade, how is that going to impact investor confidence, not only here in the U.S., but around the world?
So we deserve it in the sense that this is not an ability to pay issue. We are so able to pay, Susie. This is a political willingness to pay issue. So if rationality prevails, which at the end of the day it will prevail because there's so much at risk, we are at AAA. Now, if we get downgraded, it is problematic. Okay, it is problematic because we are the AAA, and a lot of people hold our instruments because we're the AAA, and also treasuries are used as collateral, so it would mess up the plumbing of the system. So we need to avoid, not just for the good of the U.S., but for the good of the global system, we need to avoid more downgrades.
Richard, you're, I know, a calm guy. You always make me feel a little more secure when I listen to you. So, and I sense that you have not changed your portfolio standing very much through all of this high drama, this opera. What would you say for a typical investor would be a good asset allocation as we move into the last quarter of this year and into 2014?
I think separating views and vantage point from what is long-term money, Tyler, and what is short-term money. Long-term money we've stayed invested in, and the theme I keep hitting with the team is if we don't believe there's a fat left tail event that's coming, and we didn't around this, we put a low probability of an actual default around this, you stick the course. And to me, I think the most important for upside from here is recognizing how high we've risen. I mean, we have markets that are up 20%. It has been an outstanding year. Most investors feel really good about that. But I think what it does let people do is reset on the investment horizon. So short-term money can trade ranges, lots of volatility. Long-term money, stay the course, don't chase, and stay invested.
All right, Richard Madigan, thank you very much.
Pleasure.
Appreciate you being with us. Mohammed El-Arian, great as always to see you.
Thanks.
Some stern words for lawmakers over the threat of a U.S. default on its debt. Warren Buffett, chairman of Berkshire Hathaway, didn't mince any words giving his opinion of a possible default or about the lawmakers who would allow the country to miss payments on its bills. Listen up.
It takes 20 years to build a reputation and 20 minutes to ruin it. Well, we've been building a reputation for proper fiscal behavior, with our currency at least, for 237 years. But the United States has, and we've become the reserve currency of the world in the process, and people all over the world hold our paper. So to give up or to do anything that damages a 237-year period of good behavior is idiocy.
And Buffett also called the threat to not raise the debt ceiling a political weapon of mass destruction.
And Buffett's comments about Congress were echoed by some top executives and corporations today, and in some troubling earnings outlooks for the fourth quarter. Mary Thompson has more.
For package delivery giant Federal Express, CEO Fred Smith says a partial government shutdown is grounding a good part of its business.
We have tens of thousands of shipments held right now that we can't deliver to the U.S. government, and a lot of the vendors shipping to the government are now have ceased. So there, on the margin, there has been an effect.
The shutdown and showdown in Washington hammering toolmaker Stanley Black & Decker's outlook, the firm citing a modest impact from the shutdown and budget cuts in the third quarter, an impact it sees getting worse in the fourth quarter. Chipmaker Linear Technology also cutting its forecast for the current quarter because of uncertainty about Washington. That's making its customers more cautious. That attitude unlikely to change, given a short-term solution from lawmakers, means that America could find itself in the midst of another battle over the debt ceiling just a few months from now. And Larry Fink, the CEO of BlackRock, the world's largest asset manager, says this could hurt the economy this quarter and well into the first quarter of next year.
If it feels like this is just kicking the can down the road, it's going to have a lasting damage to consumer confidence, a lasting damage to CEO behavior in terms of job creation.
Pittsburgh-based PNC echoing those sentiments, the bank predicting a slowdown to economic activity this quarter tied directly to Washington, while U.S. Bancorp says nervous customers are moving more money into cash, and the influx of deposits is squeezing the bank's net interest margin as it pays more interest on those deposits it may not be able to lend. BNY Mellon's deposits ballooning too, growing by $10 billion since the end of September. Its customers moving to cash, seeking certainty and safety for their money as Washington dithers over what to do with its own. For Nightly Business Report, I'm Mary Thompson.
Still ahead on Nightly Business Report, Big Blue reports a big revenue miss, sending shares lower after hours. That's coming up next. But first, how the international markets performed today. The U.S. economy grew at a modest to moderate pace over the last 6 weeks, but job growth was subdued. That's the assessment from the Federal Reserve's latest so-called Beige Book survey, a snapshot of business and economic conditions in the Fed's 12 regional bank districts. The report also showed that growth slowed in the Philadelphia, Richmond, Chicago, and Kansas City regions. Many businesses reported optimism about the future, but also expressed uncertainty over the government shutdown and looming debt ceiling crisis.
A bankers group says new mortgage applications were flat last week, with lending rates leveling off. Refinancings were higher, but requests for new home loans fell to a 6-year low on worries about the government shutdown.
We begin Market Focus with a trio of earnings that came out after the market closed today. First up, Dow component IBM, and it wasn't good news. A revenue miss sent shares lower in after-hours trading. The company blamed it on a sharp decline in hardware sales. But earnings beat analyst estimates, and IBM reiterated its full-year outlook. Shares finished the regular session up more than 1% to $186 and change, but dropped about 6% after hours. If the current losses hold, IBM would drag the Dow down by about 65 points tomorrow. American Express reporting a rise in net income in the third quarter, beating Wall Street estimates. The credit card company said cardholders spent more in the U.S. and abroad. Amex shares finished the day at $76.32, up almost 1.5%, but didn't move much after the bell. eBay's the third big company to report. It posted a rise in earnings, but revenues fell short, and the company issued a disappointing outlook. Now, even though profits in the third quarter grew thanks to increasing mobile transactions and an increase in the number of people using its PayPal payment processor, investors focus on that outlook. It lost 45 cents in the regular session to $53.52 and fell 4.5% after hours. Now, Bank of America reporting a sharp increase in earnings, fueled by growth in its consumer and wealth management arms. It earned 20 cents a share. That was 2 cents above Wall Street estimates and reversing a year-ago loss. But it wasn't all positive. The bank struggled in its mortgage department, bringing in just half of the revenue of a year earlier. As for the stock, it rose 2% to $14.56.
And Pepsi also beat street estimates and says it's on track to meet its financial goals for the full year thanks to strong sales of its snack foods. The company's large global reach and successful Frito-Lay division made up for declines in the U.S. soda market, and the stock popped 2% to $82.27. Shoppers are buying up Barbie, and that helped boost Mattel's bottom line. The toy maker reported a 16% rise in quarterly profits, easily beating expectations. And Barbie wasn't the only doll in high demand. Sales were also strong for Monster High and the American Girls line. The stock up 1% to $41.97. Shares of Advance Auto Parts hit an all-time high on news that it will buy General Parts International, privately held company, for a little more than $2 billion. The acquisition will make Advance the largest retailer of auto parts in North America. The news sent the stock up 16.5% to $96.16. And Regeneron Pharmaceuticals and Sanofi moved higher on promising results from a new drug they're developing. Their cholesterol drug, when used by itself, can cut bad lipids in half, something industry analysts call a potential blockbuster. Shares of Regeneron up almost 6% to $307.65. No change, though, today for Sanofi. It closed at $49.29.
And looking ahead, one of the most anticipated earnings reports due out before the opening bell tomorrow, Dow component Verizon. There are high hopes for a blowout report between the aggressive expansion of its Fios TV service and plans to take complete control of its wireless unit from its joint venture with Vodafone. Julia Borston has more.
The parent company of the nation's largest wireless carrier, Verizon, is expected to report 4% higher revenue and 16% higher earnings per share, thanks to a strong wireless business on growing margins. Pacific Crest analyst Michael Bowen points to the fact that Verizon continues to have 3 times the number of wireless subscribers as AT&T.
Overall, the subscribers out there are, very pleased with their network. Verizon continues to have probably the highest quality wireless network out there. The wireline business continues to struggle to a degree. However, Fios has been a strong point. So overall, it should be a pretty good quarter for the company.
While Verizon's landline phone business is expected to continue to struggle like all landline providers, its high-speed internet and TV services, Fios, are growing strong. But perhaps the biggest focus will be on the Dow Component's $130 billion deal to buy out the remaining 45% stake of Verizon Wireless owned by Vodafone, which Wall Street sees as a positive for Verizon's shares.
It really makes it a cleaner story as far as the entire company, and now they don't have to distribute the profitable earnings that are coming from the wireless business to Vodafone. They can keep it all within Verizon.
Verizon is in an increasingly crowded space, with T-Mobile and Sprint proving formidable rivals. Thursday morning, we'll see what kind of guidance Verizon management gives about the company's potential to maintain its growth into next year. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Coming up, the companies behind the push to reduce our dependence on foreign oil and their groundbreaking technologies that could one day secure our energy future. But first, how commodities, treasuries, and currencies did today.
In Washington today, it wasn't just the debt crisis in the spotlight. There was also a lot of talk about American energy independence. The big questions at the energy conference: why is the U.S. still dependent on imported oil? And how close are we to using the necessary technology to be self-sustaining in our energy needs? Sharon Epperson reports.
With the federal government shut down, some of the nation's premier institutions for energy innovation scaled down or shut down completely. But many companies continue to forge ahead with groundbreaking technologies that will help reduce this country's dependence on oil and increase our energy security. Corporate executives and policymakers have come together here at the Securing America's Future Energy National Summit on Energy Security to increase awareness and spark action to help reduce the nation's dependence on oil.
Energy security is a triple win. It's a win for the customer because our technology reduces the price. It's a win for the climate, and it's a win for the security of the nation. So politically, economically, and from standpoint of cost to the end customer.
The fastest and most cost-effective way we can achieve our energy goals and reduce our dependence on foreign sources of oil is to introduce more efficient engines.
Companies like Nostrum Energy are developing technologies to fine-tune internal combustion engines to increase fuel efficiency, while others like Achates Power are developing new engines, including the next-generation combat engine for the U.S. Army. Domestic oil production is booming and fuel efficiency in cars and trucks is improving. Yet with our heavy dependence on oil, the United States is just middle of the road when it comes to oil security, based on a new index measuring more than a dozen countries. But car makers are making significant strides in reducing gasoline consumption. Nissan has sold more than 35,000 battery-powered Nissan Leafs. General Motors' Chevy Volt, the first commercially available plug-in electric hybrid, has sold almost 50,000 vehicles.
This is part of a solution, really. It's not a single silver bullet solution, but it's one of a number of avenues that are available to the transportation sector.
Compressed natural gas vehicles like the Chevy Impala due out next year are another. Electrification services for truck stops are enabling trucks to draw power from the grid rather than idle or run on diesel fuel.
It's not going to happen immediately. I think we need to take a lot of steps to get there. I think electrification of transportation is a major step forward.
Another step? Plant-based fuels that replace crude oil. Of course, that will take many years.
This is a journey. It's going to take some time, but there's great innovation happening in a number of different companies, and now is the time that we need to press on harder than ever.
The result will be a more secure energy landscape. For Nightly Business Report, I'm Sharon Epperson in Washington.
And finally, today marks the 90th anniversary of the founding of the Walt Disney Company. It started out making cartoon shorts that featured a familiar-looking mouse who was then known as Steamboat Willie. Now it's number 66 on the Fortune 500, more than $40 billion in annual revenue, and all the theme parks and characters you'd ever hope to encounter.
And you just got back.
I just came back.
Is it still as magical as
always crowded, always bustling, a nice place to visit.
That's why they make all the money. That's Nightly Business Report for tonight. I'm Susie Garrett. For more on the stories we covered tonight, go to our website, nbr.com.
And I'm Tyler Matheson. Thanks so much for joining us. Have a great evening, everybody. We'll see you back here tomorrow.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our Dividend Stock Advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
Susie Garrett with a Nightly Business Report news brief. Stocks rallied after lawmakers reached a deal that will reopen the government, raise the nation's borrowing limit, and avoid a devastating U.S. default. The bill could be on the president's desk by the end of tonight. Relieved investors sent all the major indexes soaring. The Dow surged 205 points, the Nasdaq jumped 45, and the S&P added 23 points. Standard & Poor's says that the 16-day government shutdown has cost the economy $24 billion. The Federal Reserve's latest Beige Book survey of the economy showed modest to moderate growth, but that it slowed in a third of its banking regions. And Google is still the king of search. It had 67% of all internet searches in September, followed by Microsoft and Yahoo. Be sure to tune in to Nightly Business Report right here on your public television station.